Hello, my name is Marianne Kong and I lead the Asset and Wealth Management practice in PwC Hong Kong. I am pleased to welcome you to this session on a macroeconomic and geopolitical look at Asia. What to look for in the coming months. After more than 25 years working with industry players grow their business in Asia, never before have I experienced such extreme turbulent times impacting not only the economic and business dynamics, but also personal lives and well-being of so many people. The ongoing geopolitical tensions between the world's two largest economies are creating ripple effects on many other countries in Asia. And the black swan of COVID-19 have exacerbated the trend towards even greater protectionism. Amidst all these challenges, what does the future reserve for the Asian region? And how should global players position themselves in the region? In this session, I am delighted to welcome Dato Seri Cheah Cheng Hye, who is a co-founder, co-chairman, and co-investment officer of Value Partners Group, one of Asia's largest independent asset managers, to share his perspective with us. Over the next 20 minutes, we will cover 3 topics. We will share with you our views on post-COVID and impact of geopolitical tension on the region. We will share with you our views on the impact of growing protectionism and the threat of deglobalization trend on the asset and wealth management industry. And finally, our take on the market entry approach into Asia as a result of all these changes impacting us. Mr. Cheah, welcome, and thank you very much for joining us. This is our 2020 annual Asset and Wealth Management conference, and we're delighted to have you join us. So to kick off, I'd like to talk about COVID, right? So COVID took us all by surprise earlier this year. And to a large extent, we can say that in Asia, it's been managed relatively well so far. Time will tell, but I think we've managed quite well so far. But we are clearly living in a very different world. Has COVID affected your strategy and your outlook on the market?
Thank you. First, let me say it's an honor and a privilege to be invited by PwC to join this conference. The fact that we are now doing it in the virtual space rather than a big live conference with all of us together tells you the profound impact of COVID. Yes, COVID has many interesting and significant implications, not only in the financial market, but in the geopolitical sphere. First of all, as everyone knows, China, Korea have been among the leading countries in terms of managing a V-shaped recovery from COVID, while much of the Western world has been stuck so far in an L shape. And even as we speak, there's now growing fears of a second wave in both Europe and the United States. Yeah. So COVID, in fact, has all sorts of implications that will include the following. One is a growing realization that no matter whether you are those who believe China is the future or China is not the future, for the time being, China is managing to monopolize the show in terms of economics, market action, etc. There is a huge, there's a growing trend that I'm seeing in my industry of people wanting to put money to work in Chinese stocks and bonds. At our level, we are seeing inflows, we are seeing inquiries. There is a feeling that China, in fact, is crowding out other markets in terms of attracting investors. And also, because of China's remarkable ability to recover so quickly from COVID, to keep their society, as it were, under very effective anti-COVID measures. First, Chinese factories are doing very well. The latest export figures show you that Chinese exports are rising significantly despite gloom and doom just a year ago. Second, China is continuing its opening up its financial markets, and the area of finance is the one bright spot in Sino-American relations when so much else is in trouble and there's so much conflict and ill feeling. American leading financial institutions are rushing to get into China, and China is welcoming them, including reforms that allow foreigners, including Americans, to own up to 100% of asset management companies and securities companies in China. This is happening right now this year, in this COVID year. China is the one major economy able to produce positive economic growth this year, when most other major economies will report declines in their economic output. So COVID, which some people say started in Wuhan in China earlier this year, turned out to be also a situation where China is the first to recover and has been able to lead the world in all sorts of anti-COVID effective measures.
Right. And, you know, so it's interesting to see that you're obviously very bullish on China. And I would say that, you know, from a market entry perspective in terms of China, over the last at least 10 years, there's been a lot of focus on China, right? So we see a lot of international players wanting to go and establish in China. But would the geopolitical tension between the US and China, do you think, will affect the approach of people into that market?
My experience has been that governments do their thing and the private sector does our thing. The private sector, in terms of financial corporations in China, the US, Singapore, Hong Kong, etc., we are trying our best to make decent gains for our clients and our shareholders, our stakeholders. And like it or not, China is the story. They are the guys who are, right now in the world today, China is responsible for roughly 35% of economic growth. The Chinese are the guys who have the world's biggest consumer market. I've seen recent estimates that put the number of middle class people in China at more than 500 million people. These are people who spend money and need to save and need to buy financial products. So in the private space, amid all the political noise and tension, people are moving in, and there's a lot of runway, because the Chinese savings picture is as follows. China has the world's biggest pool of savings, but the vast majority are tied up in bank deposits, money market products, and real estate. Only 10% of Chinese savings are in equities. So if the Chinese elephant were to move just a little bit more to equities, we will see a huge amount of potential. So we have seen estimates produced by reputable research that suggests that in the next 10 years, the amount of funds to be managed in China will increase by between 3 to 6 times. So this is going to be the major growth driver of the entire world's asset management industry. So everyone is rushing in. On April 1st, 2020, because of COVID, maybe not a lot of people pay attention to this, but we reached a major milestone when the Chinese government effectively lifted restrictions on the entry of Hong Kong and foreign players into the Chinese financial services industry. It's very promising.
Right. And I know you have operations in Singapore and also in Malaysia. And so how do you think this, the current, geopolitical tension that exists between US and China, would that impact the rest of Asia at all?
It does, yeah. Actually, most of the rest of Asia spend a lot of energy trying not to have to choose sides between the United States and China. The US has got a major issue now because of the 4 years under President Donald Trump. People now know that they cannot count on constancy and reliability in United States foreign policy. Now we have a new president coming, Mr. Biden. He may follow a different line from his predecessor, but who knows 4 years from now what the next guy may do or may not do. So the consistency that we had come to expect from the world's leading superpower now is in doubt. People know that. All countries around the world, Europe, Asia, know that. So people are all hedging their bets. Yeah. The Chinese have been far more consistent. Like it or not, they have followed a fairly consistent line, and they pretty much signal well in advance if there's a change of policy. So I think in this situation, the medium, the small-sized countries around Asia are trying to not to have to choose sides. Yeah. But having said that, I'm afraid you cannot get away from the fact that 1/5 of the human race live in the People's Republic of China. So there's always this fear of being crowded out by China in almost everything. When it comes to financial services, their size, their market, their potential, their demand, and potentially their supply of financial products are so huge that everybody else feels crowded out. Yeah. That is true even at my company where we have Singapore and Malaysia offices, but our center of gravity is moving to Shanghai, Beijing, and Shenzhen, simply because that's where the major potential is. We've been on the mainland of China since 2009. We have got a whole series of licenses. We hope and believe that one day, not too far away, we may get a full license. And in that case, the size of the market is so much larger than that in Southeast Asia that, like it or not, we had to allocate a lot more time to the north than to the south. And with respect to the consumer goods, demand for education, healthcare, services, again, the Chinese market is just so large that we have to feel that they are crowding out everybody else to some extent. Yeah. It's interesting to note that in the world today, roughly 40% of millennials live in only two countries, India and China. Millennials are people who were born after the year 2000, from 2000 onwards. So they are the sweet spot of the global demographics, the people with the money, the youth, the education. So those guys who have lots of millennials are the ones who will be the growth engines. And that's now reduced basically to about 18% of the millennial population of the world in China and maybe 19% in India. But India per capita GDP is significantly lower than China. So their ability to consume, to make use of services is still significantly less than China. So as we move along in the 21st century, we're going to see a lot of stuff to some extent dominated by China.
You talk about millennials. We like it or not, we are facing a time when there is a growing number of protests all around the world.
Yes.
So Hong Kong, we had our fair share of protests last year. And so now it's in Thailand. Can you share some perspective with us in terms of how is this potentially going to affect?
In summary, I think following the collapse of the Soviet Union, much of the world embraced different types of capitalism. This, by the way, include the mainland China, whether under Deng Xiaoping's open door policy from 1978 or 79, we witnessed a quiet revolution where communism gave way to a form of a mixed system, so mixing socialism with some capitalist principles. But we are coming to the end of the road for the most basic form of capitalism, which is what I call the winner takes all. Because especially since the global financial crisis of 2008, it highlights clearly that the form of capitalism that we know best, and that's most prevalent, by the way, in Hong Kong, where there's a mantra of small government, and non-intervention in the private sector. Capitalism has evolved into a system where big companies dominate many types of industries and services, stifling competition. And winner takes all means that the rich get a lot richer, but the middle class and the poor go nowhere. In Hong Kong, I believe that there's been no real increase in people's purchasing power, middle class purchasing power, for at least 20 years. Yeah. On the contrary, housing prices keep getting more expensive, making life more difficult for middle class and working class people. And also with social media, people are much more aware of the inequalities of the system. And then on top of that, after 2008, governments around the world, in many parts of the world, not the whole world, were forced to intervene heavily in the marketplace and flood the market with liquidity, with money that they printed, and creating severe imbalances and deficits, and also creating a system where interest rates are very low, and it benefits people who own stocks and property, meaning the richer people. Yeah. So the system is beginning to show real trouble. And I think the response you can see, even at the PwC level, you must have seen it, that people in high places are now talking about a new form of capitalism called stakeholder capitalism rather than shareholder capitalism. It has yet to spread to Asia, by the way. But stakeholder capitalism suggests that the role of a corporation is not only to look after shareholders and create the maximum increase in earnings per share. It's instead to look after all constituencies, all stakeholders. The stakeholders include shareholders, of course, but also employees, customers, and the overall society. I think we may see more and more of that. I call it sustainable capitalism, or if you like, responsible capitalism, that tries to take a larger view of what we're trying to do. And on the overlay of all this, we have the fact that the capitalist system, which encourages companies to go for short-term results, the next quarterly or annual earnings report to get the share price up, and where executives are compensated with bonuses that are tied to share price performance, that is no longer able to address the big problems of our planet. The big problems of our planet include global warming, which threatens eventually to potentially make our race extinct to unsustainable global warming, depletion of resources, potentially down the road, a food emergency. The same amount of land is being used to feed the ever-growing population. That has been true for at least 100 years. Social unrest with social media spreading discontent among the youth. And then what was previously thought to be a good thing, which is large numbers of young people and demographics, is now potentially a danger because of the advances in robotics, automation, and AI. It turned out that job opportunities will be much less than before. So how are we going to provide jobs for all these young people all around the world, especially in the developing world? Yeah. So, and we have many other difficult issues like, I saw articles that question even the constitutional setup of the United States, which require elections every 4 years. So roughly 2 years after the president is elected, he and his team start worrying about the next election or re-election. This is not conducive to long-term planning and sustainable growth. We essentially have a 21st century that will be marked by many difficult issues for corporations, for countries, people, and for the rich as well, because the rich now have to think about how they're going to preserve their wealth. Because I think the world all around that I see is moving from creating wealth to focusing an obsession with wealth distribution. That is a very difficult one to handle.
Yeah. So many countries really are grappling with so many internal issues, right? And to a large extent, so it's not just looking at the social aspect, but also in terms of growing the economy. And we've seen a trend towards deglobalization, where a lot of countries are trying to basically bring in more services and to try to grow their own economy. And to a large extent in Asia, we're also seeing a growing trend towards protectionism as well, especially from even in the asset and wealth management industry, where we see a number of countries in Asia really wanting to grow their asset and wealth management industry, locally. And so we see this with passporting, for example, right? So where a number of countries wants to encourage local domicile types of funds, to try to really ensure that, they can also capture the growth potential in that industry. How do you think this will impact the industry going forward?
Yeah, Maria, and I think this is an excellent question, which in one question you summarize a lot of the profound undercurrents that is both helping and hurting our industry. Yeah. First, let's talk about deglobalization. Deglobalization cannot be reversed. It's an irreversible trend. Trump's efforts to deglobalize, put America first, is not Trump. Actually, it's a symptom of larger forces at work. Many people in the developed countries have concluded that deglobalization doesn't really help them. It may have helped the multinationals, but it doesn't help them. So I think we must accept that deglobalization is one of the several trends we have discussed that is undermining the world order that you and I knew so well. Yeah. Point number two is that with deglobalization, there are only a few winners left. These are winners who not only have the ability to have the supply chain, meaning supply their needs. But more important than that is that they need to have a demand chain. You must have a market, domestic market big enough to support your own industry and your own marketplace. Your marketplace in terms of R&D, production, distribution, brand building. There are only 3 major areas of the world with a strong domestic and local demand chain, local market. United States, China, and the EU. All other countries have been used to surviving based on being part of a global supply chain. I mean, supplying to big markets and surviving that way. Unfortunately, this is true of Southeast Asia. And to a large extent, it's even true of countries like Japan, territories like Taiwan. They don't have a big enough domestic market to sustain a 3-dimensional economy, only MS 1 or 2 dimension. So these are countries that have, you can call it business models that are on the way to being obsolete and may create social unrest in those countries, actually. Yeah. The second point you mentioned is related, it's about passporting. Passporting, so I'm not in the business part of my company. I'm more on the front line, fund manager, but I will share with you what I know. First of all, the only real passporting scheme that has been really successful is UCITS from EU. And that's because the European countries were able to combine to one block, and therefore the barriers were lowered. And even UCITS, I think, took several decades to establish itself. Yeah. In Hong Kong, we have MRF, which in its own way is successful. Even like Value Partners, our company, we have 40 funds, of which several are now part of the mutual fund recognition scheme that allow us to sell to the Chinese public. But success has been very limited, actually. Yeah, it's not been very easy to promote the products, and there are all sorts of restrictions. In Southeast Asia, we have a Me Too scheme, and in Asia, we also have an Asian passporting scheme. They are not successful so far. I mean, their histories are short. They have been around for less than 10 years. And these are not a trading community like EU. On the contrary, they are different countries with capital control, taxation, jurisdiction. In real life, we have found it easier to penetrate these fragmented markets through the use of local feeder funds. So we use these funds and we set up local feeder funds with specific local approval for specific local market. I think it will take a long time to overcome the problems that prevent passporting from taking off in Southeast Asia. Every country seems to have their own idea what kind of capital controls to impose and what are the tax regimes that may or may not apply. And Indonesia, by the way, the potentially the most important of the Southeast Asia, have been conspicuous by its absence from these schemes. Yeah, so far. Yeah. So I pin my hope more again on the idea that China is crowding out those markets. The Chinese are faster. Finance integration is moving at lightning pace. The fact that Chinese interest rates are roughly 200 percentage points higher than US dollar interest rates is exercising a giant sucking effect right now on money inflows. And also, at the moment, foreign investors own less than 4% of the Chinese A-share market, less than 3% of the Chinese bond market. So it's a long way to go in terms of foreign ownership. And they are going in. I think finance leads the way in terms of being the one really bright, shining spot of relationship between China and the US and the world.
Yeah, I think you're right. It's like Asia doesn't have that block advantage that EU has, right? So that's why it's been very difficult to have an equivalent UCITS in Asia, right? So you mentioned that. And so that's why, to a large extent, bilateral agreements, such as the MRF with China, seems to be the way forward. And so despite the lukewarm approach towards the MRF, it looks like new initiatives in terms of opening China, such as the Greater Bay Area, is also favoring local products, as opposed to...
we are very excited about that. Yeah, we call it GBA. GBA, Greater Bay Area, has a population of 110 million people. And the economy about the size of Russia or Australia. And the point here is that the Chinese government is going to start experimenting with lifting capital controls, specifically for Greater Bay Area, Guangdong and Hong Kong and Macau. And we are on the front line. We may have a chance to on-sell our Hong Kong products directly to the 110 billion people of Guangdong, and of course vice versa. Having said that, there is still one country with three systems: Macau system, Hong Kong system, China system. You take them some time to work out, but it's definitely most promising.
Yeah.
Yeah.
Yeah. Very good.
Yeah, I also want to say that the strength of the renminbi is another key factor. I think the Chinese are this time really serious, that they want the renminbi to be internationalized. This is yet another of the major trends we'll see unfolding in the next roughly 5 years. I think China is increasingly cautious about over-dependence on the US dollar. And they have to open the gate a little bit regarding capital control so the foreigners are comfortable holding renminbi and vice versa. So this will be something that will help along, not necessarily integration, but much bigger exchanges between the mainland of China and the rest of the world. Yeah. And also note that the new 5-year plan has just been disclosed or announced, China's 5-year plan. And they are showing the way in terms of really long-term planning. As part of the 5-year plan, they make various announcements that suggest that, in fact, China has a long-term 30-year plan in mind, not just a 5-year plan. It's a vision rather than a real plan. But the 30-year vision imagines that between 2010 and 2020, roughly speaking, per capita income in China doubled, as almost doubled. It would have doubled if not for COVID, but yeah, more or less doubled. Between 2020 and 2035, they have in mind that they will double per capita income again. Incredible. And between 2035 and roughly 2055, they wanted to double one more time. This is going to be incredible. If they can achieve even a large part of the vision, then first, China will be by far the largest economy in the world. But secondly, in terms of the financial services industry, frankly speaking, we just got to be there. Actually, everyone's got to be there. Yeah, it's a lot of implications. Third is the youth of the Chinese financial market and people. The Chinese stock market in its modern form only started in 1990. It was closed down for a long time after the Chinese Communist Party take over in 1949. They reopened in 1990 on a very experimental basis. The Chinese asset management industry that we know, most of these guys are only started in the late 20th or early 21st century. So they are young industry. In mainland China, you often see people with just 3-5 years experience managing hundreds of millions of dollars worth of funds, you know. But outside mainland China, in Hong Kong, Singapore, or the West, you've got to be a fund manager with like at least 15-20 years experience before given such a responsibility, right? So we have many interesting bridges to cross in the next 1 or 2 decades.
Yeah. So Value Partners has been in this industry for 30 years now.
Yes.
Right, so you've got a very established brand in Hong Kong. You've spoken a lot about China, right? So your focus is very much on the China market right now, and so there's still a lot of very large international asset managers who actually maybe has not even penetrated the Asian market yet, or have either looked at market entry into China or planning to. Can you share some perspective with them in terms of, how to do well in such a huge market?
Yeah, I wish I really know how to answer that question because there are many different scenarios possible. But first of all, let me just say that yes, we started our business in 1993, and at that time we were managing just $5.4 million US dollars. Today we're managing more than 13 billion, and all along the way, PwC has supported us. We appreciate it. You are our first and only auditor in almost 30 years.
Thank you.
Second of all, to say that I think there is no single formula that is good for everyone. For Value Partners, as a Hong Kong company, we got ourselves listed in 2007, and we knew we had to do China. So in 2009, we opened our first WFOE, Wholly Foreign Owned Enterprise, in Shanghai in 2009. Last year, by the way, we bought our own office space in Shanghai. So we now don't rent an office. We have our own space, yeah. We have seen that time during that period, we learned some interesting lessons about China, and also we became really convinced of the China story and the opportunities, yeah. I think with China, here are a few points that are worth bearing in mind. One is, as I mentioned, the relative youth of the financial market. It means that a lot of people there, they don't do fundamental research. They don't do what we would call professional investing. In fact, just so you know, there are roughly 170 million people in China with registered broking accounts. That means they trade, and they really trade by that. I mean, there is the world's most active stock market in terms of volume of turnover. And 80% of daily trading is done by small retail investors, many of whom seem to be intraday traders. So they're trading more like well, you could even say a casino, you know? So the foreign institutions like us who go there, we had to be very clear that our specific value added is that we are in a different space. We are professionals, we do fundamental research, and we buy, for us, we have viewed the medium to long-term investment. Yeah. So that's where our value added space is. Second of all is to me, very difficult to solve issue of distribution in this vast country. The truth is, Chinese distribution is still controlled by just a number of players, especially the major banks, fintech platforms, and insurance companies. For us to try to reach the Chinese public is very uphill up to now. So I think the next potential revolution for us is to figure out how are we going to reach our customers in a cost-effective manner. There's lots of people out there we know. As I mentioned, there are roughly 500 million middle-class people that we can reach. But how do you reach them? The way to reach these people now has become very specialized, very large scale, and requires huge economies of scale that most foreign players probably don't have. I think in practice so far, foreign players have largely tried to do joint ventures or partnerships or collaboration agreements with Chinese banks. So we are the factory, we produce product, you sell it for us. And we split the fees roughly 50-50, yeah. I'm not sure it's the best possible model, but it seems to be the path of least resistance.
Right, right. Okay, I know that's great. Just as a final comment, any final advice you would give to international players who don't yet invest so much into the region or China?
I think it's not a bad idea. Let's take Value Partners, which is managing slightly over 13 billion US as of last week, with a track record brand. We have 200 people in our employment, of whom roughly 100 are investment professionals. And we are doing roughly 6,000 to 7,000 company visits a year. It will be quite difficult to replicate what we have. So why not work with us? What we've done is that we have been able to receive sizable mandates. Just last week, we received a very large mandate, I won't go into detail, from the United Kingdom, a large UK company. So we received similar mandates from endowments, colleges, etc. in the United States, Japan, Europe. That's one way to go, to team up with people who already put in the money and the resources. Yeah. I want to be frank with you, Maria. And asset management industry, as I know it, and I've been in it now for about 30 years, has changed a lot, especially in the last 10 years or so. It's become an industry that, to a large extent, you either have to be very big or very small. Cannot be in between, because it's scale. You need scale and size to support the kind of research resources, compliance, middle and back offices resources that I have. And I don't want to compromise on that because it may compromise the quality of my brand. So I need to manage a lot of money to be able to do the business model that I'm pursuing, right? So I need people to use me, use my platform, and I need to raise more money as well. And together, we can have a very high service standard, professional level, world-class asset management company. So I personally believe that for Value Partners, we will have to become much bigger than we are today. And China gives us the golden opportunity. Either that, or you are a very small boutique that does only a few customers and a lot of your own money, and just go for performance, and hope for the best in terms of your back office support. Yeah. Those companies that are in between, neither big nor small, may have a difficult time, especially as the opening of China will allow the winners of the space to become very large size, able to hire the best talent, afford the best support services, the best auditors, and the best distribution. And these guys, like so many other things you see in the world economy, will come to dominate the whole space. Yeah. So winner takes almost all. Yeah, that's the way the industry is going.
Yeah. Mr. Cheah, thank you so much. It's always so insightful talking to you each time. And we truly look forward to continue growing with you and take on the challenge together. Thank you.
Thank you very much indeed.
Thank you.